Hello, welcome to Debt Market Update from Canara Robeco. I am Avnish Jain. As usual, let's start with the geopolitical situation. Geopolitical situation continues to remain tense with the ground assault started in the Israel-Palestine conflict. Now, more non-state players like the Houthis are getting involved from Yemen, and there is risk of more players getting involved over the medium term. While the US presence in the Gulf region is a strong deterrent for the state players like Iran or Yemen getting involved directly, the non-state players continue to play a big role in attacking Israel from all sides. This is likely to be a protracted war, and as of now, there is no end in sight. The impact on world markets obviously remains because of this conflict. This is the second conflict after the Ukraine war, which continues in the Russian region. The impact on global markets is primarily due to higher oil prices, which impact growth in countries which are large importers of oil like India. Now coming to the international and trade markets, US economy continues to remain buoyant, and it is one of the largest economies in the world and has the impact on global financial markets. The US Federal Reserve is expected to maintain pause in its policy, which is scheduled in the next few days, but they will continue to maintain a hawkish stance with higher than longer rates narrative. US rates have already risen a lot in the past few months. This is primarily due to the large US fiscal deficit, which is expected to be around 6.3% of the GDP for 2023, which is pushing up rates as supply becomes larger and larger in the US markets. In the medium term, the rate markets are likely to remain volatile in US, and since the US rate markets impact global rates as well, global rate scenario also remains uncertain. We have seen the European Central Bank pausing on rates, and the Bank of England is also expected to continue to pause on rates. Inflation continues to remain high in the advanced economies like US, UK, and the Europe. Despite the sharp increase in rates across the world, because of the large fiscal deficits the governments are running in these countries, the inflation has not decelerated to the extent expected by the central bank. So it will take some more time for the rates to bite into the consumer spending and bring down inflation over the next few quarters. That is why central banks are pausing and giving the narrative of higher for longer rates till they are sure that inflation does not go up again at a faster pace than expected. Coming to Indian markets, as expected, the Indian markets have been impacted more by global cues than local cues. If we look at inflation, in India, it has come down as expected from a number of 7.4% in July, when because of food prices, inflation went higher. It has trended to 5% in September, and in October is expected to further go down to around 4.25 to 4.5%, which is well within RBI's range of 4% to 6%. However, RBI has been pushing markets on the narrative that they want inflation at 4% from a longer term basis. Considering that growth continues to remain robust and resilient in India, the expectation is of 6.5% GDP growth for FY24 and around 6% next year. RBI can take the stance of keeping rates higher for longer again, similar to what is happening globally, and continue to see inflation trending lower and coming under control via the monetary policy. Coming to rate markets reacted to sharp rise in US yields in the past few months and have gone up by about 15-20 basis points, which is much lower than what we have seen in the global markets. Nevertheless, 10-year is now stable between 730 to 740, as opposed to around 710 to 720 range, which was there about 2 months back. Inclusion in the global indices, which has been already announced with the JP Morgan Global Index, which will kick in next year around June 24. The inclusion will kick in the global index. Also, it is expected that Bloomberg Index will also include India sovereign bonds in there global index. That will enable almost 20 to 30 billion dollars coming next year from FI flows on a passive basis. On active basis, one could see 5 to 10 billion also come in. So next year, as of now, seems positive for their rate markets. But on the macro side, still things remain uncertain. Though on the supply and demand balance, demand side would be much stronger in anticipation of the FIF flows which are expecting next year from the passive flows on index sides. We expect that rate cycle probably will ease in FY24 globally because now central banks are mostly on pause mode. But again, it's a question when the rate easing starts because the war in Ukraine as well in Israel-Palestine can continue to impact markets on the shorter term. And globally, oil prices are a main factor can play havoc with countries which import oil and on the inflation as well. For investors, things look little murky now, but we believe that FY24-25 would be good year when rates could ease from the highs we have seen globally as well as locally. And it gives an opportunity to investors to, in fact, invest at a relatively higher rates, which are existing now, and take opportunity when rates come down next year. Investors can choose to invest in corporate-heavy funds like banking PSU debt, corporate bond fund, and short-term funds, where you get some buffer because of high corporate bond exposure. As well, since the duration is medium duration, you would also benefit when rates go down in next 1 to 2 years. From a risk perspective, there is also reduced risk on interest rate side because of medium duration, which is in these type of funds. Investors should continue to invest based on their risk return profiles. Wishing everyone a very happy Diwali and New Year. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.